You're tuned in for another deep dive, and today we're tackling something pretty big hitting the oil and gas world.
That's right. The 2025 tariffs, they're really putting a squeeze on upstream operations.
Yeah, exactly. And we've got some great material to help us unpack it all. We're looking at insights from EAG Inc., specifically around, strategic back office outsourcing.
And their report, Tariffs and the Upstream Oil and Gas Sector 2025 Realities and the BPO Advantage, it lays things out quite clearly.
It does. So our mission today, really get a handle on how these tariffs are impacting the industry's costs.
And explore a key response companies are looking at, business process outsourcing, BPO.
Right. And just to kick us off, here's something that jumped out, that the average U.S. trade-weighted tariff. It's gone through the roof. We'll get to just how much in a bit.
It's a really dramatic shift. I mean, the economic landscape for upstream just changed fundamentally. It wasn't minor tweaks.
Well,
And to really get the impact of these tariffs on, everyone involved, it helps to remember the scene at the start of 2025.
good point. The Permian Basin, as our sources highlight, was absolutely dominant, still is, projected to be nearly half, like 49% of all U.S. crude output this year.
Wow, almost half.
Yeah. And we were expecting, decent growth there too, maybe 4 to 5% higher than last year,
Yeah.
driven by the usual things, efficiency, tech, pipelines.
So even though rig counts were down from, say, the post-pandemic peak, the Permian was still set to be this production powerhouse.
Definitely.
But it's interesting, you said overall U.S. growth was actually slowing a bit, expected to land around, 250,000 to 300,000 barrels per day increase.
That's the estimate, yeah. It suggests a shift maybe towards prioritizing efficiency and returns rather than just volume everywhere.
Makes sense. And you mentioned technology, things like the longer laterals, multi-well pads.
Exactly. Getting more oil and gas from a single spot. Plus, AI was becoming more common, helping maintain production even with fewer rigs working.
Right, so operators were really leaning on that tech.
They were. And at the same time, you saw more consolidation. Big companies like Chevron, for instance, looking to boost their Permian output quite a bit.
Just ramps up the pressure on the smaller guys, doesn't it?
Absolutely. Intensified competition.
Yeah.
Meanwhile, things like day rates for rigs, drilling activity, they were kind of stabilizing. Oil prices were hovering, mid-60s to low 70s a barrel.
Okay, so that was the backdrop. Relatively stable, focus on efficiency.
And then, bam,
Yeah.
these tariffs hit.
Right. Let's dig into the tariffs themselves now. The report gets pretty specific. First, there's this universal 10% tariff, hit almost all imports. That kicked in April 5th, 2025.
Universal, yeah. That's broad.
But then, and this is where it gets really impactful, the tariffs just on goods from China, they jumped massively.
225%.
Okay.
Effective just a few days later, April 9th.
And potentially even higher, right, up to 145% with other fees mixed in.
That's the potential, yes. It's just a huge, huge increase. Almost hard to picture.
It really is. And when you think about what that means for upstream.
Well, yeah. Think about steel and aluminum. The tariffs on those doubled to 25%. And not many ways around it. Very few exemptions.
And those materials are everywhere in this industry.
Everywhere. Drilling rigs, pipelines, wellheads, casing. I mean, the basic infrastructure relies heavily on steel and aluminum. So a 25% tariff, that's a major cost hit.
It's not trivial. And it's not just the U.S. imposing tariffs, is it? There's the blowback.
Exactly. Retaliation. China hitting back with 84% tariffs on U.S. goods. The EU put 25% on American products.
Wow, 84% from China.
Yeah. And then even our neighbors, Canada and Mexico, most imports from them got hit with 25% tariffs too, though there are some carve-outs under the USMCA trade deal.
So it's this complex mess of new trade barriers suddenly appearing.
A real tangle.
Yeah.
Which leads to the critical question for companies and, for anyone trying to understand their situation. What does this do to costs right now?
The immediate impact.
The report gives a pretty stark example. Just the steel tariffs could add, say, $1 to $2 million to the cost of drilling a single deepwater well.
1 to 2 million per well.
Per well. That's a huge chunk out of a project's budget. And that's just direct material cost.
Doesn't even count supply chain headaches.
Exactly. The retaliatory tariffs, the shifting trade patterns, they just cause disruption. Getting the equipment you need might suddenly become way harder, take longer.
And all this is happening while oil prices are doing their usual volatile thing.
Precisely. So it puts immense pressure on profit margins.
Which brings us back to that stat from the beginning, the average U.S. trade-weighted tariff. You said it exploded.
Exploded is about right. The estimate is it surged from around 2%
Okay, 2%.
to 24%.
24, wow. That's more than a tenfold increase average across the board.
Yes. You can immediately see how that kind of shockwave travels through an industry like oil and gas with its global supply chains and significant import needs.
Absolutely. So, okay, costs are up significantly. It's a tough new reality. What can upstream companies actually do about it? What are the strategies?
Well, this is where BPO, business process outsourcing, really comes into the picture as a very practical strategy.
Okay.
The report and the insights from EAG Inc. really highlight it as a direct way to push back against these tariff costs.
So the idea is farming out some of the back office stuff.
Essentially, yes,
Yeah.
non-core functions. And the savings can be quite significant. The sources suggest something in the range of 30 to 40% reduction in those specific operational expenses.
30 to 40%, that's substantial. So what kind of functions are we talking about? Land administration, accounting?
Those are key ones, yes. Land lease management, complex production accounting, joint interest billing, regulatory compliance reporting.
Stuff that has to be done but isn't actually drilling for oil.
Exactly. And EAG Inc., for example, specializes in exactly these areas for upstream and midstream companies, handling revenue processing, production reporting, regulatory filings.
So by letting specialists handle that, companies cut their internal overhead.
Right. That's the core cost reduction piece.
Yeah.
But there are other benefits, too. Scalability is a big one.
How so?
Well, think about it. If you have a big in-house accounting team, that's largely a fixed cost, right?
Yeah.
Salaries, office space, software licenses.
Sure. You pay whether you're drilling 10 wells or 50.
But with BPO, you often structure it so those costs become more variable, tied to activity levels. So if the market dips or these tariffs force you to scale back activity temporarily, your back office costs can adjust downwards too. It gives you flexibility.
Okay, that makes a lot of sense. Converts fixed cost to variable. More adaptable.
Mm-hmm. And then there's the expertise factor.
Access to specialists.
Yes. BPO providers live and breathe this stuff. They have teams focused solely on, say, land administration or production accounting. They're up to date on the latest rules, the best technology.
Especially important with complex new tariff rules, adding another layer.
Definitely. Staying compliant can be a real challenge. Having dedicated external experts can really minimize risk and ensure things are done accurately and efficiently.
So it frees up the company's own team.
It lets the internal team focus on the core mission, finding and producing oil and gas. Innovation, strategy, getting bogged down in processing invoices or filling out regulatory forms.
Okay, so the benefits stack up. Cost savings, scalability, expertise, and focus on core operations.
Pretty much sums it up.
And the report actually gives a concrete example, doesn't it? A Permian operator.
It does, yeah, a really good illustration. This operator was looking at about $4.2 million in extra annual costs, purely because of the tariffs.
Wow, $4.2 million. From what? Steel? Equipment?
Yeah, higher steel prices, more expensive drilling gear, even things like sensors manufactured in China suddenly cost a lot more. It added up.
So what did they do? They went the BPO route.
They did, but strategically. They didn't just outsource everything randomly. They targeted key areas.
Which ones?
Land administration, production accounting, and their entire IT infrastructure.
Okay. And what were the results? Were they measurable?
Very measurable. Land admin costs, for instance, dropped from $1.8 million a year down to $1.1 million.
That's a $700,000 saving right there.
Right. And efficiency gains elsewhere, too. Time spent on regulatory reporting, it went from 120 hours a month.
Wow, that's 3 full work weeks.
Down to just 45 hours a month.
Huge difference. Frees up internal people for other things.
Absolutely. And accuracy improved, too. Accounts payable processing accuracy jumped from 82% to 98%. Better financial control.
And the IT outsourcing.
That wiped out $650,000 a year in IT costs. Servers, software, support staff, gone.
So adding it all up.
Well, those specific actions freed up about $2.7 million annually for that operator.
$2.7 million out of the $4.2 million hit. That's significant mitigation.
Very significant.
Yeah.
And crucial because they could then reinvest that capital, put it back into optimizing drilling, finding ways to build more tariff-resilient supply chains.
Makes sense. Using the savings to adapt further.
Exactly. Plus, a side benefit was faster revenue recognition because the BPO partner had better, more centralized data systems. That helps cash flow, especially when prices fluctuate.
Okay. So for the leaders listening, and really for anyone trying to grasp the implications here, the key takeaways seem pretty clear.
I think so. First, these 2025 tariffs. They're not a minor issue. They have fundamentally changed the cost structure for upstream oil and gas. Full stop.
Yeah. Materials, equipment, supply chains, everything got more expensive.
And second, BPO isn't just theory. It's a proven, practical strategy companies are using now to fight back against those costs,
It offers cost savings, yes, but also that flexibility and access to expertise.
which are incredibly valuable in this kind of uncertain environment. It helps navigate the complexity.
So it sounds like companies that are proactive, that embrace strategies like BPO, they might actually gain an advantage here.
I think that's fair to say.
Hmm.
By becoming leaner, more efficient, maybe more focused on their core E&P strengths, they could potentially weather this storm better than competitors who are slower to adapt.
Preserving capital, focusing on growth, even with these tariff headwinds.
Precisely. Taking decisive action now can position them better for the long run.
Okay, so wrapping this up. This deep dive, I think, has really highlighted the serious challenges from the 2025 tariffs for upstream oil and gas. Costs are up significantly.
No doubt about that.
But we've also looked hard at a viable strategic response, business process outsourcing, showing how it delivers real benefits, cost, flexibility, expertise.
Hopefully it gives you, the listener, a good shortcut to understanding this pretty complex situation.
Yeah, getting you up to speed quickly. And maybe one final thought for you to chew on as we finish. Given these intense tariff pressures and seeing the potential of BPO, what other sort of established ways of doing things in the oil patch might be due for our rethink in today's economy?
That's a great question. The industry is often seen as traditional.
Right. So are there other operational models, maybe things taken for granted, that need a fresh look now? Definitely something to consider as you keep track of this vital sector.